tutorial, we will examine both managing your share portfolio and managed funds. Because there are many similar attributes, and as managed funds could also be used to purchase shares, these two asset classes will be discussed in parallel. This group of assets is part of your growth assets, the other being real estate. For demonstration purposes, screenshots will come from a 20-year plan for a single person with one share portfolio account and one managed fund. In addition, there will be $100,000 in the transaction account. John the citizen is aged 55 and has a salary of $120,000, of which he is saving 10%. John will retire at age 65, thus you will have a plan displaying 10 years each for savings and retirement. John intends to take a 5-year interest-only margin loan in year 1 to borrow $50,000 to purchase shares. We are often asked if you can maintain a live feed of current shares. The answer is no. Financial Mappers is cash flow modelling software, and as such, it is not appropriate to list actual shares. You can't say that in 5 or even 20 years you are going to buy, say, BHP shares, but you can model the likely outcomes if you plan to either buy, say, $20,000 worth of shares or sell a similar value of shares. The actual share names are not relevant. It is important to list an approximate purchase price of the current portfolio so the capital gains tax can be calculated when the shares are sold. With Financial Mappers, you can change the default rates and reset the rates to those nominated by the program. With Financial Mappers Pro, the administrator is responsible for setting the default rates. These default rates cannot be changed except by that person. All users on the platform, including ProConnect clients, have the same default rates. Therefore, if you are a ProConnect user, you may find that when using your platform, you will have different default rates to those in this document. The default rates are those set by Financial Mappers for the single-use product and sold online. When required, there is the option to use specified rates. The Financial Mappers default rates have been derived from the 20-year average investment returns from the year 2000. During this time, the capital growth for shares was 5.47% and established housing 6.71%. The GFC had a significant impact on share prices. When selecting the default rates for shares in real estate, it was felt that Financial Mappers must be completely neutral. If one looks at the very, very long term, there is little difference in rates of capital growth. However, the properties of each account are significantly different. It was decided to be fair that the combined average of shares and property should be used to give the same capital growth of 6.12%. When it comes to income from shares and property, these figures are quite arbitrary, given the various types of shares and property one can purchase. Again, it was decided to give the same income values. The default dividend rate for shares is 4.25%. The default net return for property is approximately 4.25%. The gross income return is 5% with recurring costs of 15%, giving a net return of 4.5%. The total return for both shares and property is 10.75%, which is a real return of 8.05% when discounted for the inflation rate of 2.5%. The methodology used to determine the income and capital growth for managed funds was to assume that a typical fund had an allocation of 20% defensive assets and 80% growth assets. This calculation resulted in an income of 4.48% and a capital growth of 6.12%, a total return of 10.6%. That is a real return after a 2.5% inflation rate of 7.9%. However, there are many times when the managed funds will have a completely different composition of assets, and you must decide what is an appropriate rate of investment return. The program assumes that a share account consists of domestic equities. If you invest in international equities, there could be value in using a managed fund for the account. This way you can allocate your shares to both domestic and global equities. This is an example of a 60 to 40% split between domestic and global equities. In managed funds, the asset allocation has a set of default allocations. However, you can overtype this allocation to design a fit which matches your actual funds held. The following is a display of the allocation of each investment profile starting with no growth. No growth has 100% in defensive assets and no growth assets. Low growth has 10% growth assets. Conservative has 30% growth assets. Balanced has 50% growth assets. High growth has 70% growth assets, and aggressive has 90% growth assets. On the assumption that shares are likely to be self-directed, the management fee defaults to 0%. However, a fee can be included if required. The fees for managed funds default to an entry fee of 2% and a management fee of 1%. You can activate a performance fee with the default rates. This allows you to toggle between results with and without performance fees. When the specified rate for management fees is selected, you can also include a trailing commission as a percentage of the fund. This value is included in the total management fee, but is displayed in the graph when included. We are unlikely to see trailing commissions in the future due to government regulation. There are two sets of graphs displayed for your managed fund fees. The following are the default investment returns for shares and managed funds. Because the multi-sector funds have been used for this demonstration is a high growth fund, the specified rate of 5% income and 7% capital growth has been nominated. With the share account, there are three options for dividends. The additional option is where dividends should be paid if there is a loan. The option for the loan will override the other options for either savings or retirement phase when applicable. These are the options: during the loan, bank account or always reinvest; savings period, bank account, always reinvest. In the retirement period, you have an additional option which is to reinvest until a specified year. The options for managed funds do not include the option for the loan, as managed funds do not have a loan facility. This is the option selected for the example. If you choose to borrow money to purchase managed funds, you should select the share loan category. With tax and tax credits, both shares and managed funds have the same options. The default method of taxation is taxed as income, but you can also select a specified tax rate or tax-free. As the software is designed for international use, the Canadian tax credit is included. In addition, both Australian and Canadian methods can be employed, and this allows customization of the inputs. For this example, the share portfolio has a tax or imputation credit of 70% and the managed funds has 40%. In this example, the account shows whether the funds have been transferred to the transaction account or reinvested. In this case, they have been transferred to the transaction account to help fund the loan expenses. In both accounts, the value of tax credits is not displayed. However, the tax credit is added to the dividend in the tax estimator, together with the value of tax credits being displayed as either refundable or non-refundable. In both cases, the drawdown has been activated to draw down the funds over 25 years commencing in year 1. The share account has the option to include a loan linked to the account. When the margin limit is ticked, then the percentage of equity is calculated. There is also a warning if the fund exceeds the margin limit. This could occur where the value of the funds fall when the capital growth modulator is activated. It could also be triggered if you try to borrow more than the nominated limit. If for any reason all the shares are sold, the loan will automatically be repaid where the loan is a linked loan. An unlinked loan is a loan not attached to a particular asset but where the loan purpose has been nominated for either shares, investment property or home. By clicking on the link next to the Edit Loan, you can customize the loan. The loan types are interest only, principal and interest only followed by principal interest only with options, the options being introductory interest rate and refinancing the loan, In this example, the loan is an interest-only loan for 5 years starting in year 1. The loan application fees and ongoing fee of $100 have been included. Note that these costs are not indexed. Financial Mappers does not cater for a loan linked to managed funds. However, if you need to use this type of loan, then you should create an unlinked loan by clicking through the option for all investment loans and select New in the View Share Loans section. This option can also be used to make additional share loans. The loan funds will be deposited into the transaction account. When the managed funds are purchased, the loan funds will already be in the account ready to pay for the purchase. Note that in the list of share loans there is a chain or link besides the share portfolio and not the managed fund. This loan was not included in the example and was deleted by clicking the delete icon. In the investment plan, the allocation to the interest-only share loan for the first 5 years is allocated first. Note there is no provision to adjust the loan costs for any dividend income. In both 5-year periods, 40% of the investable funds are allocated to the share portfolio and the multi-sector managed fund. This allocation is paid directly to the nominated account. Any buying costs will be deducted. In the retirement income, $80,000 for 10 years has been nominated. On the plan outcomes, the significant graphs you should look at are investments, assets and liabilities, return on investments, asset allocation in 2 formats, investment and risk profiles. For a more detailed explanation, refer to the tutorial. Financial Mappers is designed to be educational and fun to use. Sometimes it's not about creating complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions you make. We like to think you can use Financial Mappers as a doodle pad where you can look at very simple concepts and then try to understand what is likely to make the outcome better or worse for you.